Welcome everyone. I hope you're having a great day. Thank you so much for taking the time to join us. Today's webinar will focus on opportunities within the growing senior healthcare industry, mainly investing in senior living facilities. It is top of the hour and I do want to be respectful of your time, so let's get started. I'm Reneika Lightbourne with Advanta IRA. I'm delighted to welcome Isaac Dole, CEO of Birchwood Healthcare Partners. Thank you so much, Isaac, for being our featured speaker. Isaac will give us insight into how senior living investments can offer long-term growth with lower risk compared to other sectors, some of the current trends he's seeing, and also how Birchwood has created stable and profitable returns for their investors. But before I turn it over, I do want to give you a general overview of how self-directed IRA works, and of course the process with Advanta IRA. If you have questions, feel free to type those in the question box. We will allocate time at the very end of the presentation to get those answered for you. So let's go ahead and get going. Again, I'm Reneika Lightbourne. I'm one of the business development specialists. I've been with Advanta as an employee since 2019, but I'm also an Advanta IRA client prior to joining staff. So self-direction is something that I advocate both personally and professionally. After today's call, if something you want to learn more about or you want to kind of talk through your scenario, you're always welcome to give me a call or send me an email. Most certainly go to our website, advantaira.com, to schedule a consultation with myself or one of my colleagues. Just a little housekeeping before we get started. I just know that at Advanta, we don't give any tax, legal, or investment advice. All of the information presented today is just for educational purposes. As always, we encourage you to consult with your professional team and do your due diligence before making any investments. So if self-directed IRA is a new concept for you, I just want you to know, I know it can be a lot of information, but just 3 key takeaways. Just know that any IRA or former employer plan, like an old 401k, qualifies to be self-directed. 2, the beauty is you get to choose what is it that you're investing in. Today, we're focusing specifically on senior living opportunities. And then, of course, all of the income that's generated from that IRA, from that investment flows back into the IRA. If there's any related expenses, it's paid out of the IRA. Just a little history about Advanta and who we are. We've been in business for 21 plus years now as the leading self-directed IRA administrator in the industry. Our headquarters is located in Clearwater, Florida, but we do have an office here in Atlanta, which is where I'm based. While we don't give our clients any tax, legal, or investment advice, our team is comprised of attorneys and also certified IRA service professionals. We have a little over $3 billion under our administration. We work with clients nationwide. One of the things that we pride ourselves on is providing our clients that concierge style service, meaning you have a dedicated account manager with you through the life of your account with us. You know who to reach out to if you need assistance. And then, of course, providing free educational content that include or features experts and practitioners such as Isaac to come in and knowledge share on different types of opportunities within that you can invest in using IRA funds. So this webinar is recorded. It's going to be uploaded onto our YouTube channel later today, but you can also access it on our video library. I would continue to encourage you to check out our events page, a wealth of knowledge in terms of upcoming webinars, or if there's a topic that you're interested in, you can certainly reach out and let us know. You can check out our blog, but also my colleague Alex hosts our podcast, which is a great resource for you, just a different format. So anything and everything related to self-direction, we have you covered. So exactly what is a self-directed IRA? Just to keep it simple, it just means that you as the account owner, you're going to have complete control over the investment decisions. You have complete control over your IRA funds. You get to decide exactly what is it that you want to invest in. You get to diversify outside of the traditional stocks and bonds. Our clients use IRA funds to invest in a wide range of things. It's near limitless, mostly real estate-related assets. Today, again, we're focusing on senior living facilities. You can certainly use IRA funds or old 401k funds to invest in private equity, precious metals, oil and gas. The list goes on and on in terms of what's on the table for you when it comes to using qualified retirement funds. So why do people choose to self-direct? You can look to self-direct for many different reasons. I'll just touch on 3 of them. For you as an investor, it can be a new source of capital. So instead of tapping into your rainy day fund or taking out a bank loan, if you have funds that's sitting idle in an old 401k or an existing IRA, you can move them as much or as little as you want to make that investment. If you are a syndicator or a capital raiser, retirement funds is a great resource for you to do that, just because there's nearly almost 40 trillion in retirement funds, And of that, about 4% of it is truly self-directed, meaning invested in alternative assets. So a great way for you to raise capital if that's what you're looking to do. Another reason as to why someone may look to self-direct, because of the volatility in the stock markets, the ups and downs. No one can predict, when it's going to be up, when it's going to be down. Something overseas can impact the stock market here in the U.S. But we know with real estate, it's a tangible asset, and senior living, the underlying asset is real estate. It's a tangible asset. It's always going to retain value. People are always going to need a place to live. In this case, with seniors, they're going to need a place for care for the duration of their life. And then, of course, the tax benefits, having those investments, those profits, those dividends flow back into your retirement account, tax-free or tax-deferred, depending on the type of account that you have. In terms of the different types of accounts that can be self-directed, it's the ones that you're already familiar with. So if you were to go to the IRS website, you won't see the term self-directed. Again, self-directed just means you choose what is it that you're investing in. But the actual account type for individuals is going to be traditional or Roth. Traditional pre-tax, meaning you get a tax break up front, you grow your account over time. Once you reach retirement age and you take it out, that's when you pay taxes at that point. Whereas with a Roth IRA, you're electing to pay taxes up front. As long as you've held that Roth IRA for 5 years and you're 59 and a half, which is the retirement age per the IRS, those distributions would be tax-free. If you are self-employed or have a side business or an entrepreneur, you can certainly look to self-direct a SEP, simple or solo 401k. A solo 401k is usually very attractive for our real estate professionals or more business owners. Again, if you want to know more about that, you're welcome to give me a call and we can do a deeper dive on that. Some lesser accounts that can also be self-directed but are just as important are educational savings accounts. If you have kids, you can certainly look to diversify and actually be able to invest for their education. If you have a high deductible medical insurance plan, you can certainly look to self-direct that HSA account. So check with your plan provider to see if that's an option for the type of plan you have. And of course, any former employer plan, whether it's an old 401k or 403b or 457, you can certainly look to move those funds. The only thing I want to reference is if it's a current employer and you're not yet 59 and a half, then of course, that's where the restrictions would come in. You can certainly ask to see if they'll make an exception, but if it's an old employer plan, you can move it. There's no issue there. If it's a current employer and you're not 59 and a half, then don't be surprised if they tell you no, just simply because that's industry standard IRS rules in terms of not being able to move current employer plans. In terms of funding your account, there are several ways you can fund your account, which includes moving funds from an existing IRA. So let's just say you have a brokerage IRA at a Fidelity or Charles Schwab. You can move as much or as little as you want or need to. There's no tax liabilities for you to do that. It's simply a trustee-to-trustee transfer. You would fill out our paperwork. Advanta will submit that transfer request over to the other IRA custodian on your behalf. You're just indicating exactly how much you want to be moved over, and it will get those funds transferred over to your Advanta account. If you have an old employer plan, you would actually have to initiate that request. We'll guide you through the paperwork in terms of filling out our application and also telling you the verbiage that you need to let the other plan administrator, the old 401k, know. You're not taking a personal distribution. You're just simply moving it from your old 401k over to another IRA. There's no tax liabilities for you to do that as well. They'll report to the IRS that X amount of dollars left to your old 401k, and then will report that X amount of dollars was received in your new account with us. So it neutralizes, again, no tax liabilities. The other way that you can fund your account is by making annual cash contribution. This is the contributions for 2024. I know the IRS typically releases contribution limits late October, early November, so we anticipate that's going to be coming out shortly for 2025. But for 2024, you can contribute up until tax deadline next year or your extension. So for traditional or Roth IRAs, you can put in $10,000 if you're under the age of 50, $8,000 if you're over the age of 50. For a SEP IRA, simple and solo 401ks, that's where you have higher contribution limits. So for example, for SEP IRAs, you can contribute up to 25% of your compensation, not to exceed $69,000. With a solo 401k, essentially you're contributing twice. You're contributing as an employee, but then you're matching as an employer. So if you're under the age of 50, you can put in $69,000. If you're over the age of 50 with solo 401k, you have that additional $7,500 that you can put in. So again, a sizable amount that you can put into a solo 401k if you're eligible for it. For ESAs, you can put in $2,000 per year per child. For HSA, again, check to make sure you have a high deductible medical plan. But for individuals, you can put in $4,150. If you have a family plan, you can put in $8,300. And also, if you're over the age of 55, specific to an HSA, you have the ability to put in an additional $1,000. When you're ready to get started, done your due diligence, and you know you want to be able to proceed, we've really streamlined that process for you here at Advanta in terms of getting your account open. You can simply go directly to our website, advantaira.com, or you can reach out directly to myself or one of my colleagues, and we can walk you through the paperwork. We get your account open typically within 24 to 48 business hours, more likely 24 business hours, sometimes same day. And then, of course, we assign you that dedicated account manager who's going to work with you and the investment provider when it's time to make your investment. And then step 2 is funding your account. You can use a combination of either making an annual cash contribution as long as you have earned income, or you can transfer from an existing IRA or do a rollover from an old employer plan. And then finally, start investing. What is it that you're interested in? Is it going to be something that Isaac mentioned today? Is, senior living facility and the opportunities presented and there's of interest to you, or is it going to be private equity? Again, you have a blank canvas when it comes to self-directing your account. And with that, I'll go ahead and turn it over to our speaker, Isaac. Let me make you the presenter. Just bear with me.
My presentation is going to be about Birchwood, Campbell Street Services, and Impact Healthcare, the 3 businesses that we run within the seniors healthcare industry. I'm going to talk about demographics and trends in our industry. And then I'm going to use a case study to showcase what we do on a day-to-day basis. First and foremost, we're thrilled to partner with Advanta to accept retirement funds. We think it's a great method of investing. We have what's called a GP fund that we're closing here in the next 30 days or so. And so feel free to reach out to me regarding the industry generally. Happy to talk you through any questions that you might have after this presentation. So Birchwood, my background is as a broker. So I started off as a senior housing and nursing home broker selling communities around the country. I then worked at a healthcare REIT called Aviv REIT. I was managing director of acquisitions there. So I was acquiring senior housing communities and nursing homes around the country and negotiating triple net leases with operators. The company doubled in size while I was there from about 175 facilities to 350 facilities. The company went public in 2013. I left and started Birchwood in 2014. In 2015, the company sold to a larger healthcare REIT called Omega Healthcare Investors. I have a lot of transaction experience, about $1 billion in this industry, structuring, refinancing, selling communities. So deep experience in this niche industry within healthcare and within real estate. The map that I have up is our current portfolio. So we have facilities in the Midwest primarily. So we own and operate 24 communities in the Midwest. And then we have nurse practitioners and licensed clinical social workers in other states like Florida, Texas, California, Indiana, and just opened up Virginia. This is kind of size and scope of our industry today. We have, there's about $1 trillion of seniors healthcare assets in the industry. And I'm going to talk a little bit about, what the senior housing, from a real estate perspective, what the senior housing industry is comprised of. But it's a large and growing, I'll say, cottage industry of both healthcare and real estate. We serve about 1,800 residents today across our portfolios. Across our portfolio, we have about $125 million of revenue. We've made 26 investments. That's just under Birchwood. Prior to that, with Aviv and my experience as a broker, I've been a part of hundreds of millions of dollars of transactions in this industry. Here are a few more statistics just on us. We have 24 communities that we currently own and operate. We have a 25th that we have a passive investment in. We have, this number is actually up to 55 now. We just took on a portfolio of senior housing communities in September. So we have 55 corporate employees at our management company. And then we're really proud of some of the statistics that we produce on an annual basis regarding care and our engagement with employees, which leads me to this next slide. We have ambition to be the employer of choice and provider of choice in each market that we serve. And so what that means to us is, we compete with fast food and retail for employees. And so recruiting and retention of our team members is critical. So we offer some specialized programming to retain talent. Like, we just launched this company called Dollar, which is a student loan repayment program. RAIN is a daily pay program. Marketplace Chaplains embeds a chaplain in communities that can provide mental health services for people facing various issues. And then the Giving Tree is our nonprofit affiliate that I started when I started Birchwood to support our team members who are facing financial hardship. So think about a car breaking down that can really unravel someone's life when they're living paycheck to paycheck. So this is an area of strong focus of ours. MPAC Healthcare is our nurse practitioner, licensed clinical social worker platform. We have about 70 providers, 50% nurse practitioners, 50% licensed clinical social workers. These providers are embedded in primarily nursing homes, and their purpose is really to prevent rehospitalizations. Rehospitalizations are high cost and great risk to the resident. So to the extent we can pick up on changes in condition in their current care setting and prevent transportation, admission to a hospital where there's infection, we're going to do that. And that's really where the industry is going. So the more coordination across the ancillary services in our industry and the facility-based care, the greater the outcome regarding episodic cost and clinical outcomes. So that's really the direction the industry is going. Regarding just what we do, so Birchwood, we acquire communities primarily. We are involved in healthcare services a bit, but our core business is acquiring senior housing communities and nursing homes. There are about 30,000 facilities across the country, 15,000 nursing homes and 15,000 senior housing communities. There are 5,000 operators, management companies that operate these communities. So it is a highly fragmented, very local business. And so, you think about the distress from the pandemic in particular. It is a very challenging industry, especially if you're not at scale. And so we will buy one-off or portfolios of communities, and there's typically something broken in the facilities function, like the clinical function. They don't produce great clinical outcomes. The physical plant has deferred maintenance. Vendor management, just managing expenses more closely or bringing them onto our vendor programming, our global vendor programming. I mean, if you're a one facility operator, you're just not going to get the pricing and service that we have at 25 facilities. And so there are a number of different variables that go into practice when we acquire a community. This example here, Stone Ledge Manor, we purchased in 2016, and we bought it from a guy who was using a hard money lender as his revolver lender, his working capital lender. And so his hard money lender was literally sweeping cash out of his bank accounts every day, and he didn't know if he could make payroll. And so he had vendors coming down on him, he had his lenders coming down on him. And so simply just recapitalizing the community and reducing the number of vendor and lender inquiries into what was going on just brought a sense of calm to the community so that people could focus on care and improving the employer culture within the building. And so we went in there and did what we typically do and focus on a better clinical product, stabilize the workforce. We improved, one of the halls, for instance, had poor lighting. So we went in there and touched every department, and you can see here the impact that we had on EBITDA prior to selling the community years later to a more local operator. Most of our communities are in the Midwest. This is another example. It was a mom and pop operator. They had developed these buildings, I believe in the 80s. We bought this portfolio in 2016. Over the course of the last really 10 years, we just sold the remaining communities from this portfolio this past summer. But mom and pop, we purchased 4 communities, a home health and hospice together. Over the course of the next 8 years, we added 3 more communities that were also owned and operated by local operators. We eventually sold the whole portfolio to a Oklahoma-based operator, and then we sold the hospice to a hospice operator. But again, you know, the clinical product here was pretty good. The physical plant product was pretty good, but they did not have a strong sales and marketing program with the area hospitals. And so repositioning these communities to attract certain resident profiles and increase the clinical capabilities to take care of more medically complex residents was a big part of our business plan here. So that local connectivity with doctors and other referral sources, organizations in the local community really helped us to improve performance here. And as I said, we just sold out of this portfolio after 8 years in the last 9 months here. So zooming up into the seniors healthcare industry generally, we're at a really interesting time. The industry has talked about the silver tsunami, baby boomers turning 85 plus, which is kind of the average age of our residents in our communities. They've been talking about it for 10, 20 years. I mean, really my entire career. But in reality, those baby boomers, the silver tsunami doesn't even really begin until 2030, but it's finally here. So when you're acquiring communities today, it will be impacted by the dramatic change in demographics over the next 25 years. Historically, a lot of non-industry investors and developers came into our industry prematurely. So in 2010, from 2010 to 2020, and I'll go through this in a little bit, a lot of hotel and multifamily investors and developers came in and doubled the capacity of senior housing. Well, they were early. They were early by a decade. And so that combined with the impact of the pandemic led to a significant level of distress over the last few years. But now we're finally entering this window where the growth of the baby boomer generation is just going to take off over the next 20 years, as you can see here in this slide. So this dynamic is only exacerbated by the fact that over the last 4 years during the pandemic, I'll flip to this slide here. Over the last 4 years of the pandemic, there has been virtually no new building stock. And so you think about that, demographics are going to move in our favor materially over the next 25 years, yet building stock has remained stagnant, if not decreasing, throughout the pandemic due to distress, construction costs, availability of construction products. And so it's just a really interesting dynamic here coming out of the pandemic and going into this silver tsunami. So pricing right now still reflects the distressed state of the industry coming out of the pandemic. So anyways, very interesting dynamic related to all the distress that's happened here going into the pandemic because of overconstruction in certain submarkets, during the pandemic just because of the rise of labor costs, dramatic decrease in occupancy in most cases because of closures and the impact of the pandemic. And so things are just starting to stabilize now post stimulus. But you know, you think about it, we're preparing for this wave of demographics, but we don't have the building stock for it. So, and construction costs Capital costs too are still high, so there's still not much development going on, and that's been the state of development for the last 5 years. Going back to just the composition of the industry, there are a lot of terms that are thrown around regarding senior housing, nursing. There's some generally accepted terminology within our industry. Senior housing is private pay, lower acuity. Nursing is largely public pay. Think Medicaid, Medicare. Higher acuity, so think nursing homes. So this is kind of a nice graphic that outlines the various levels of care and cost as you rise within the healthcare continuum. It's all acuity based and payer based, and so the more acute the resident's needs are, and the more specific the resident's payer source is, the more it's going to push you into a certain facility of care. So on the lower levels of senior housing, it's typically private pay. A number of states do have Medicaid waiver programs that you can qualify for, but the vast majority of the units from memory care on down, memory care, assisted living, independent living, active adult, age restricted, multifamily, that's all going to be private pay for the most part. And I should know this statistic, but I don't, but call it 10% of all private pay of all senior housing residents may be on Medicaid or some Medicaid-like program, whereas up in the nursing home category, long-term care and short-term rehab, which means hip knee replacement, you go into a rehab center, a nursing home, and then you're discharged 20 to 30 days later. That's going to be primarily Medicare, Medicaid, VA, some other insurance product, and very little private pay. This graphic here basically shows what is included at these various care levels. So multifamily and active adult are somewhat similar. There's a little bit more programming within active adult. Once you go into an independent living, that really just means there's a kitchen. So there's a little bit more programming, service, but meals are really the big distinction between active adult and independent living. As you climb into assisted living and memory care, you start getting into more robust care needs. So ADL is activities of daily living. So think about, getting dressed, brushing your teeth, moving around a building, getting assistance in your daily life. And so that's a measurement, and that really determines what level of care you need within a community. And then you get up into skilled nursing, which is both short-term and long-term stay. The short-term, again, is post-rehab, coming off of a surgery and getting back home. And then the long-term is more of an end-of-life, high care needs, largely bedridden in most cases, or in a wheelchair. So that's really the distinction across the acuity spectrum. We generally think that right now is, as I said before, just with the distress coming out of the pandemic, the changes in demographics over the next 25 years, it is just such a unique and opportune time to be very active in our industry. The pandemic completely upended our industry, and so professionals, communities, capital, everything was thrown up into the air, and there's just this great reshuffling of resources and assets within our industry. A lot of businesses did not make it through the pandemic. A number of them restructured and worked through some very difficult issues, including us. I mean, no one was unscathed. But it is the great realignment right now from our perspective. And so that ushers in some incredible investment opportunities where in most cases, an acquisition is not about what the acquisition pricing is related to replacement cost. It's how much below replacement cost are we talking about here? And so we have some very active REITs in our industry. We're trying to be very active right now as everything is reshuffled. As I said, we're in the midst of raising a GP fund right now that we hope to close here in the next month. So we intend to be very active. We've taken on 13 communities this year, so we've been pretty busy. This is a good snapshot of just what happened over the pandemic. And so the top left graphic here is the various acuity levels: independent living, assisted living, and nursing care. And so you think about the pandemic started, and most buildings were closed. I mean, you could not access them. Non-employees could not go into the building. So you may recall people talking to their loved ones through windows, but it had pretty restricted access, which means occupancy levels fell dramatically during the first 12 months of the pandemic, and really into that second year as well. So you can see that here. Occupancies are I'll say quickly rebounding. They're not to where they were in pre-pandemic levels, but we are recovering as an industry. I will say that a lot of buildings closed, particularly within nursing care, where reimbursement did not track inflation. And so there is a lower supply, but ever increasing demand. And so occupancy levels are quickly rebounding at this point. But the construct of the industry has changed quite a bit since the pandemic has begun. I'm going to just walk you through an acquisition of ours. So this is an acquisition that we completed in January of this year. The community was owned by 4 individuals who had experience in our industry. They came together to build this fairly new constructed transitional care community. What that means is it's heavy Medicare. So a lot of people post-surgery are going to this community for heavy rehab before going back to home. But it's one of the nicest communities in Iowa, with excellent clinical results. But the 4 owners just did not get along. And so, people sell for all kinds of reasons. In this situation, the 4 owners were having a hard time making decisions and getting along. So we worked on this for a very long time. We had relationships with a couple of the owners, and so we successfully closed on the purchase of this in January. You'll see here we closed on the purchase at a number that was $4 million below replacement cost. I mean, this is a really nice building that was likely overbuilt in some areas, and the partnership dispute really drove the sale. But it is core to our portfolio now, and continues to produce great clinical outcomes. So this is representative of kind of they're all a bit different, but this one was really exciting to us, just given the clinical track record of this community and the quality of the physical plant relative to most nursing homes in the industry. Here's an org chart, an entity org chart. So up here is that GP fund that I referenced, which owns a large part of this facility. But typically in our industry, we separate the real estate from the operations. The operator is the employer, the licensee, and is really the owner of the P&L of the business. And then the real estate has the mortgage. And so this is a very typical entity org chart for our industry and how this particular facility acquisition was acquired. Here's an aerial just to give you a sense of the community. There are only so many configurations of senior housing communities and nursing homes out there. There's a big emphasis on line of sight, so that there are nursing ratios related to how many residents each nurse can cover. And so trying to optimize hall length and viewpoint from nursing desks is important. So you'll see kind of the shotgun hallways in a lot of communities. Here's some interior pictures, and then I can get into some of the investment thesis itself, but I am also completely open to any questions that anybody has.
Okay, so I do have a couple questions that pop in. You can certainly go through the deal, but one of the question is, which geographical areas are showing the most promising for senior investment? I know you mentioned that you guys are focused in the Midwest, but is that where you're noticing the greatest return in terms of opportunities?
I think opportunity is a function of the going in basis or price, coupled with the strength of the operator that you put into the community. And so neither of those variables are geographic in nature. And so I just kind of fundamentally, I believe in basis, and I believe in the management company, and those are the two guiding lights to the success of an investment. So you can take any acuity, any geography, any size building, and if you buy it right and you have the right management company in place, you'll be successful. And if you don't, you probably won't. And so, you can go into urban New York City or very rural Nebraska, and I think those two variables hold. So that's my general philosophy. You got to keep in mind there are only 30,000 facilities in the entire industry in the entire country, and so it's not, there are probably 30,000 apartment buildings in Chicago. So it is not a huge industry.
Okay, next question that came up relating to performance to this particular case study you're showing us, the one that you acquired earlier this year. It says, what is the expected return on investment for investors?
At the asset level, so we have different levels of investment. So this 5V GP fund, we're targeting 18 to 20% net IRR to our investors. At the asset level, the built, because we also will raise capital at the deal level. Sometimes at the deal level, we want a gross IRR of 20% plus, so 25% plus coming out of the asset level.
Okay, next question that came in also too, if you have more questions, feel free to type those in. It says, how long is the typical investment hold timeline? Is it 3 years, 5 years, 10 years?
We're like right now we're really underwriting to around 5 years. We typically have a year or two of to invest, and then let me take a step back. When you make an investment, it's going to take a year or two for us to execute our business plan. In that year 2 or year 3, we're typically refinancing. That new loan typically has a 2 to 5 year loan term. And so, case in point is this community that I have pulled up. We just received a term sheet to refinance this, which has a 5-year term on it. And so I'd say 5 years plus minus a couple of years is kind of how we underwrite. I mean, we underwrite to 5 years right now, but that can extend or contract based on, sometimes it's an opportunistic sale, sometimes things are going really well and we just want to hold, like the portfolio that I pulled up earlier in Oklahoma, we owned that from 2016 to 2024. But from an underwriting perspective, it's 5 years.
Okay, next question is, by a GP fund, you mean a general partner, and are their tax benefits passed along too? So that's a question. If you're using self-directed IRAs, then also it's a tax sheltered account, but he's just asking in general, by a GP fund, you mean general partner, and are there tax benefits passed along?
So, the GP fund, yes, it's the general partnership. So that our GP fund participates in the carried interest of the deals that we're doing right now. And so, from a tax benefit perspective, it's capital gains. Whether you're at the asset level or the GP level, it's capital gains. So that there's not really a distinction, between the deal level and the deal level and this GP fund. But the GP fund does have outsized returns due to its participation in our carried interest, and so the promote of each of these deals.
Thank you, Isaac. And just so our listeners, if you're using self-directed accounts to invest, then you're not subject to that capital gains. If you're using it outside of the retirement account, then that's where the capital gains comes into play. So again, this is another reason as to why a lot of self-directed investors like to use those funds, because to alternate and invest using retirement funds. It says, what is the minimum investment amount to invest via a self-directed IRA account?
Candidly speaking, this is a new relationship with us. So I just encourage you to reach out, and I'm very optimistic about our relationship with Advanta, and so this is somewhat new territory for us, and so we'd love to have the conversation.
Okay, yeah, so yes, definitely feel free to reach out to Isaac and his team. He has contact information on the screen, as well as his email. Also, too, at the end, you can reach out to me, and I'll be able to provide a copy of the slides, which will have his contact information. It says, do you have any investment opportunities that do not produce UDFI, so unrelated debt? So with self-directed accounts, there's UBIT, unrelated business income tax, and then UDFI when you're investing in real estate, unrelated debt finance income tax. So it just really depends on how the deal is structured in terms of how the returns is coming back to the investor. If it's coming back as dividends or interest, then you may not be subject to UDFI, or UBIT tax, or if it's structured as a C Corp, and then that's sometimes some ways providers can help investors circumvent UBIT tax. But again, it just depends on how the entity is structured. Isaac, I don't know if you want to add anything to that.
Nope, I don't have anything to add to that.
Yeah, so UBIT, it just really depends on the deal structure and how are you investing passively, or if you're investing actively in a business, then you could be subject to UBIT tax. Next question that just popped in, and we'll answer some more questions, and then you can continue through the slides. It says, you were talking about refinancing in 5 years, but you can't guess interest rate in 3 to 5 years. So your answer is a little speculative, correct? That's the common question.
Sometimes, we will never bump up on a maturity date, a loan maturity date. And so there have been times over the course of Birchwood's history where we have opportunistically sold and paid prepayment penalties to our lenders. And it's been fine because, we've received such a premium that, we can just absorb that. If we start bumping up to a loan maturity date, then we're talking about refinancing and just continuing the investment. So hopefully that answers your question. We will not sell, or we will try not to sell in a poor capital markets environment. So like right now we don't want to be selling anything. I know I said that we were selling, we sold our Oklahoma portfolio, but that process started two years prior. And so, right now is, not a great time to sell. So we'd refinance and extend.
Okay, one last question that just came in, and we can go continue with slides. It says, so is the GP fund strictly for the NK project? I think that was just your example of a recent case study that you guys just completed, but you have other projects that you're currently or actively going to be raising for, correct? That's a GP fund.
I'm sorry, did you say the NP project?
No, the Anki, but the case study that you were showing up.
Oh, Ankeny?
Mm-hmm.
Oh yeah. Okay. So right now, so here's so if you if you can see my screen, the 5V Seniors Healthcare Fund is our GP fund, and Ankeny is part of it was the first investment from the 5V fund. And so we have, I think it's approximately $1.6 million from the 5V fund into the Ankeny investment. We also made a $750,000 investment from the fund into a new senior housing development in Minnesota. Developments are so rare right now, and we were able to plug a hole in their capital stack. So we were able to get some GP and LP economics from the sponsor. So that's the second investment, and then the third investment should close later this year, and that is a portfolio of 10 communities in Iowa that we're buying at a very low basis from a REIT that is selling due to its operators' distress. So that's the third. We're only investing $250,000 from the GP fund into that because that's part of our co-investment responsibility on that deal. We have an all-cash partner who is putting up the rest of the capital on that one.
Okay, thank you. We can continue with the rest of the slides.
The rest of the slides are really just the background on this Ankeny opportunity, Ankeny investment. So I'm happy to go through them, but I typically find it's a lot better to just answer questions that people may have, or I'm happy to go more granular on this if there aren't any other questions.
No, there's some more questions that just popped in. Feel free to ask more questions. One of them is related to like risk management. So what's the primary risk associated with investing with senior living facilities that in terms of how do you and your team mitigate?
Oh, there are a million risks. There are risks in any investment. We're talking about we have about 2,000 employees. So you think about all the things that go on with employees. We have about an equivalent number of residents across all of our facilities. So risk is everywhere. However, one major difference that we pursued from the beginning of Birchwood, Birchwood's been around for 10 years. The first, call it 5 or 6 years, we largely relied on third-party operators to run our facilities. So we did that under a JV structure. In 2018, we started our own management company so that we could have more control over the people and resource allocation. And so I'd say the biggest change that we've made over Birchwood's history is take as much management in-house as possible so that the economic and control alignment across investors, lenders, just all the stakeholder groups and entities, the more alignment, the better. And so now, for instance, my name is on the license of each of these communities. My name is on a lot of our loans. And so the more alignment that we can have across all these facilities, the better. And then really it's the people. The people make or break risk. So we have an excellent clinical nursing officer, COO. We have a risk management team. So that's largely related to compliance. So there are a lot of people involved. As I said, we now have a management company of 55 people. Each one of them touch risk in some way, and the goal, obviously, to manage it as best as possible.
Okay, more questions. It says, how do you find communities? Like, how do you locate?
Like the acquisition opportunities?
Yeah.
That's a core competency of ours. I started off as a broker in this industry, so working with owners to sell their communities. And then I was managing director of acquisitions for a publicly traded REIT. So worked very closely with brokers and investment bankers and operators and other institutional owners who were selling their communities. And so this industry is small. And so just given the volume of transactions that we've been involved with, we know the lawyers, the brokers, the institutional owners. I mean, a lot of these people are friends. And so, you get text messages or emails or phone calls like, hey, we've got this building that, we're trying to do something with. What do you think? So the normal channels are available to us, and we have a leg up on a lot of the buyers out there because we've done business with a lot of these people. I've worked with a bunch of the brokers in our industry, so you can have more candid conversations with the brokers. But in addition to that, we've done a lot in this industry. So people just call us. When maybe it's an outlier community in a state that they no longer want to be in. Maybe they can't figure out how to turn something around. They're having a leadership issue. So I can give all kinds of examples like that. Maybe it's a culture issue where we have a similar culture to a seller, and the seller is really conscious about who they want to sell to so that their employees and residents end up in a positive culture, which is common in a people-heavy industry like we have. And so that is a core competency of ours. Our director of acquisitions is actually a 20-year broker, former broker. So like me, has just kind of been in and around this industry for a very long time.
Wonderful. Next question is, hospitals, healthcare systems are considered a low margin industry. How does your business model minimize the risk in achieving your overall ROI?
I'll go back to the two guiding lights of investment opportunities in this industry, and I'm sure it's applicable to a lot of others. Buy low, get the greatest management company you can possibly get. And so we are very disciplined on the buy. You have to be. That is the best risk mitigant possible. And so we will, this portfolio that we're purchasing from a REIT, the REIT is tired of talking about it on its earnings calls. They just want to be done with it. Their operator is extremely distressed and is on the verge of filing for bankruptcy. Our JV partner has the ability to buy it all cash, and all in, we're buying this portfolio for $18,000 a bed. Market pricing at the moment is somewhere between $25,000 and $55,000 a bed, depending on the market, quality, and size of the building. So we are significantly below market. It's a very complex transaction, but if you are buying at that level, you can make some mistakes along the way. And so we are very careful about how we get into opportunities. And then the other part is executing the business plan. And so you want to make sure that you're working with a management company who knows what they're doing. And I personally think that working more closely with our captive management, where you can say, instead of like a problem in a functional area, you can get a little bit more exact and say, this person over this building's function is having an issue. And so you can make micro adjustments as opposed to investors who don't have an affiliated management company where they have to take macro adjustments and swap out the whole management company if it's not working. So I personally think it's a great risk mitigant that's been very helpful to us.
Wonderful. Just getting comments saying thank you, great information. I know we're right at the top of the hour, so if there's any last questions, feel free to put those in. But Isaac, I do want to tell you thank you so much for coming in and knowledge sharing and kind of giving us just the overlook of the silver tsunami that's coming and the opportunities that lies in your industry. Again, if you have questions relating to self-directed IRAs, feel free to reach directly out to Advanta IRA. We're happy to have you as a client. We're happy to talk to you, just have that conversation, educate, knowledge, share. If you want to know more about Birchwood, definitely here's Isaac's contact information. Reach out to him and his team. And any parting words before we end the webinar?
I really appreciate the opportunity and look forward to opening up another channel to work with people.
Wonderful. One last question just came in is, have you developed an exit strategy after a certain amount of years? I know you mentioned the 5 years, depending, plus minus, but that's a general question that just came in.
There are the exit strategy. We know the very active and large buyers out there. So they're typically operators, private equity, or REITs. And so, typically we get to a point where, I mean, I honestly, a number of times we've just had people who come up to us that we know who have, been willing to pay a strong number for our investors. Other times, it's, like the Oklahoma portfolio, we owned it for 8 years. And so the market conditions were favorable when we went out to sell it. We achieved a strong exit price. And so it's very circumstantial.
Okay, thank you. That covers all of the questions. And again, we're right at top of the hour. Again, thank you everyone for taking the time to join us. Happy investing. Thank you, Isaac. And I look forward to working with you and your team.